Let's get started.
Welcome to the Financial Purpose Podcast. All opinions expressed by me or guests of the podcast are solely our own opinions and do not reflect the opinion of Life Moves Wealth Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Clients of Life Moves Wealth Management may maintain positions in the securities discussed in this podcast. Hey there, welcome back to the Financial Purpose Podcast. This is episode 69, and rather than channeling my inner Beavis and Butthead, I'm going to go ahead and go right to business. Welcome to the show. I'm going to get my head in the right place. And before I kick this off, this is a great time for business owners. I just want to remind you of the Business Transition Summit coming to Scottsdale, Arizona, Tuesday, February 25th, 2025. It's just 6 weeks, 8 weeks away, whatever it is. Close. It's super, super close. Go to businesstransitionssummit.com and at checkout, use code LIFEMOVES. It'll bring your ticket price down to $295. Super affordable. It's a one-day education. It's a no sales event. Nobody's going to get you to buy anything. Nobody's going to try to put you on their program. Nobody's going to ask you to sign up for anything. It's purely a full day of excellent education put on by business owners, for business owners. I want to see you there. We have only 100 seats. They are filling up. BusinessTransitionsSummit.com. Use code LifeMoves at checkout. Okay, today I'm recording this on January 6th. You probably won't hear it for another day or two past that, but January 6th is famous because in 2014, Florida State won its national championship. Go Noles. It's been downhill ever since. But it happened on January 6th. It's also, speaking of FSU, it's Jameis Winston's birthday. Happy birthday, Jameis. We love you. Still, if you don't love Jameis, turn off the podcast now. Okay, anyway. January 6th is also famous for another reason. And we could do a whole taping on why that is, but I'm going to, instead of that conspiracy, we're going to talk about some money conspiracies because they're a lot of fun. And I figured January 6th, there's a lot of back and forth about what happened on that day back in 2021 and why it happened, who was involved, blah, blah, blah. Anyway, all of that. Let's talk about money conspiracies. And these are going to be things that you might encounter on social media, something on the microphone, social media, or like a piece of lint or something. I don't know. Or across the fence, or at the water cooler, or at the family dinner, or something like that. These are conspiracies that I'm going to completely identify, name, and then completely bust. So here's the first conspiracy. I feel like this one's kind of a cheapie because we've talked about it a couple times, but here's the conspiracy. Cash is king. Keep your money in the bank because holding large amounts of cash is the safest way to preserve wealth. It keeps your money safe, and it's in traditional savings accounts, so you avoid all risks. Okay, here's why that conspiracy theory is false. Number one, with high interest rates, low interest on savings, although I will say for the past 2 years, while the Fed had rates high, interest on savings has been a bit higher, and there's been some higher yielding, high yield savings accounts and things like that. But traditionally and generally speaking, when we're at some sort of neutral or regular-ish monetary policy, low interest on savings accounts, long-term growth of potential investments as an alternative. Holding too much cash is a guaranteed way to lose purchasing power over time. So the longer you hold on to a large bucket of cash, the less valuable it becomes over time. You're way better than trying to chase a 3 or 4% rate of interest on a high amount of cash. You're better to keep some cash in reserve and then take the rest of it and invest it and have a potential to earn more money than what the cash is yielding. So as an example, if we look at 2024, we started the year with most high yield cash accounts paying somewhere around 5 to 5.5%. Let's just say on a rough target, 5 to 5.5%. Meanwhile, the stock market earns better than 20%. So if you had pulled all your money out of the stock market to reduce risk because the 5% yield on the cash was more attractive, you missed out on a significant amount of return in 2024. So what I always advocate for, in fact, if you go to the very most recent episode 68, where I talked about the 5 financial planning steps to take and then the 5 additional level up steps, one of those was to have a cash reserve set aside with enough money to handle common or maybe unplanned emergencies, but with a target amount. And then once you've saved that amount, every dollar above that should be put to work. One of the level up things I talked about was having an opportunity fund, which is where you have money that's set aside for opportunities. So in the event that there are things like market pullbacks, or if you want to invest more money into the market, or if you want to buy a business or buy a competitor's business or invest in a real estate property or buy a house or something, you have your opportunity fund, but that's all cash that has a designated purpose. Holding cash just for the safety aspect really isn't that safe, and in fact presents a lot of reinvestment risk because it just loses its value because of inflation. So here's the truth. Of course, number one, cash loses value to inflation. That was redundant, but that's truth number one. Truth number two is long-term wealth growth comes from investing in assets like stocks, real estate, and business. And then truth number three, focus on having liquidity for short-term needs, as I just said, and investing for long-term growth. You need both. You need a healthy mix of both, and that is asset diversification. So false conspiracy, cash is not king. As I've said in prior episodes, cash flow is king. Cash flow gives you more options. Cash gives you the ability to handle short-term funding or short-term emergencies that then you can replenish. But having too much cash in the bank is a bad idea. Make sure you have a little bit of savings for emergency, for cash reserve, and then the rest of it should be invested in other places where it can earn more than the cash yield. All right. Conspiracy number 2, debt is evil. You need to pay off all of your debt before investing. All debt's bad. You should never invest until you're 100% debt-free. And here's why this is false. This is outdated. This is not a true money conspiracy. And the reason why is because it comes from fear-based thinking, and it comes from fear-based thinking around what we define as quote unquote, air quote, financial freedom. The thing that we need to remember is that not all debt is created equal. High interest debt like credit cards and other high interest consumer loans, those should be paid off quickly, but low interest debt like a mortgage loan or a business loan could be a tool for building wealth. So a lot of people in this country who have a mortgage loan, who had it in existence before 2020, refinanced during the pandemic when rates went back down into the 3% range, or the maybe the 4% range. And so if you have a mortgage that's in the 3% right now, why are you in a hurry to pay that off when you can earn way more money in other places and other investments and things like that? Let the investment returns pay that loan. If you're really concerned about paying it off, you really shouldn't be just racing to put money into a mortgage that's low interest, because we'll talk about this here in a bit, coming up on another conspiracy. But if you pay off that mortgage and you have a free and clear house, you're going to pat yourself on the back and you're going to tell everybody that you're debt free and your mortgage is paid off. But the problem is you've just trapped all of your liquidity, and there's only 2 ways to get it out. Number 1 is to borrow against it, or number 2, sell that asset or sell that house. So if you've got a low interest, you don't have to be in a hurry to pay that off. There's no real win there unless you have so much wealth in other places that it's irrelevant. But for most people, you should be building wealth and let the loan, a low interest loan, just service it. Or, as I said, let the earnings pay for it. So paying off low interest debt too early or to aggressively prevent you from missing out on compounding growth. You're paying to the bottom side of the balance sheet rather than the top side, which is asset growth. So, truth number one, focus on paying off high interest debt first. Now, if you have high interest debt, you can do one of two things. You can either look at what your cash flow is and how much high interest debt you have to pay off, and you can create a plan where all of your free cash flow goes to knock that debt out and get it completely gone for a short period of time and then start investing. If it's a lot of money and it's not something that you can pay off, say, within a year, then what might make sense is to service the high interest debt, pay more to the balance as an additional principal, and also carve out some money to make sure you save for yourself. If you have the option through your employment, or if you're the business owner and you have some sort of retirement savings account, make sure that you're still funding that thing while you're paying off your high interest debt. If it becomes a cash flow issue, then reach out to me, info@lifemoveswealth.com, and we can see what's going to make the best sense for your cash flow and put a plan in place. Maybe we do this in stages, maybe for 6 months or 8 months or 12 months. You're attacking that high interest debt, and then we shift to doing a 50-50, or maybe it's a 70-30, 70 to the debt, 30 to retirement, or whatever. We can figure all that out. I'm using the percentages. They might not make sense because oftentimes you can't put 30% of your money into a retirement account. I get it. But it might be 30% of the extra money or whatever. So we can figure out how best to shape your cash flow to make it make sense. But you want to get the high interest debt paid off because it's going to give you more flexibility. Number two is the truth, which is utilize low interest debt strategically to invest in appreciating assets, like maybe a piece of real estate, an investment real estate. Maybe it's a business loan. Maybe you're investing in a business loan, or you're taking a business loan so you can invest in your business, like buying inventory that's going to sell quickly, or buying a piece of business or a competitor's share of business, or maybe you're investing in a new plant so you can expand, or whatever it is. Use low interest debt to strategically invest in things that are going to grow and pay back that loan, so that way you're building wealth while you're borrowing at a low cost. And then truth number three, don't sacrifice investing for the sake of paying down every debt. You do not need to be 100% debt free before you start investing. Let's come up with a plan. Let's actually do financial planning. Let's be strategic about how you're using your money. Your outcomes will be better. All right, conspiracy. What is an conspiracy? Conspiracy number three. I love this one because I hear this, I don't know, probably 7 or 8 times a year. I hear it every time the market has a little bit of a pullback. I hear it every time there's something happening in the Middle East where there's a little bit of a flare-up. I hear it all the time. I hear it every time that the dollar has a little bit of weakness. And here's the conspiracy. The dollar is going to collapse. Buy gold and buy crypto right now because the dollar is almost there. They're going to go to removing the petrodollar, and the BRICS are going to destabilize the dollar, and you're going to want to protect yourself by converting all of your wealth into gold and silver and cryptocurrency. That's a great conspiracy, except it's not true. Here's why. That's all fear-based rhetoric. It's been around for decades. And while inflation and geopolitical risk are real, the dollar remains one of the world's most stable and trusted currencies, even though we could argue that it's monopoly because the Fed is just printing money anytime that they want to, need to. We put so much money into circulation as a COVID response that none of it's real. It's not, backed by anything. We've been off the gold standard since 1972, blah, blah, blah. We can do all of that, but the US dollar is still the world reserve currency for good reason. We have the most stable economy. We have stable markets. We have stable political systems. There's no jeopardy really. I mean, I know, again, because we're talking about conspiracies, we could go off into all the conspiracies about how truly weak from within our country is, and maybe how truly weak our government is, and maybe how foiled it is and polluted by outside money and outside politics. We could do all that stuff, but we're talking about the dollar as it is right now, with all of those things considered. At face value, the dollar is still the most stable and trusted currency in the world. Gold and crypto can absolutely be part of a diversified portfolio, but pulling all of your money out of cash and putting it all into these assets and betting that everything's going to go to hell is incredibly risky, and it's not at all grounded in reality. And frankly, I've been waiting for this to happen for years and years and years and years, while everybody is telling me that it's about to happen. I mean, I've been hearing it, I think, almost my whole life, that the world's coming to an end, the United States is coming to an end, the dollar's going to crash, nobody's going to have any wealth, nothing's going to, whatever. It's never happened. So here's the truth. Number one, as I said, the dollar remains the world's reserve currency for many reasons. Oil is traded on the petrodollar, which is backed and based on the US dollar for many reasons. Stability is what the global economy needs to circulate. And a lot of stability comes from the US dollar because the dollar is backed by the full faith and credit of the United States government. They can continue to print it. They can do that. But even though they continue to print, because of how much our economy here in the United States circulates, the velocity of money is generally high, meaning it trades hands a lot. Money is always in motion in this country. We have a very stable consumer. We have a good job market. We have a lot of things going for us that a lot of other countries don't. The BRICS, right? So B for Brazil and Russia and India and China, those countries that are supposed to destabilize us, name me one of those countries that's completely stable politically, economically, and socially. I'll wait. Meanwhile, the US dollar is strong, it's vibrant, and it's secure. And it's secure because of us. Those of us listening to the podcast, we make the US dollar a secure reserve currency. Truth number two, gold and crypto can potentially hedge against volatility, although if you look at crypto pricing over the past couple of years, I would say hedging against volatility is actually not what it does. It's actually been a very volatile asset. And gold has traded volatile as well. And actually, a lot of people say that gold generates really good returns. But if you actually go back and look at the returns on gold compared to almost any other asset class, it's really not that great. So gold is not a great investment for long-term wealth accumulation. But having a little bit of gold, having a little bit of crypto in your portfolio is good. They can be hedges against volatility. They can be good diversifiers, but they should never replace things like stocks, bonds, real estate, business, interest, and of course, cash. Should always have those. And then truth number three, wealth is built through long-term investment strategies, not fear-based moves. So anytime that you're feeling freaked out because you've been watching the news, and I don't care if you're watching CNN, CNBC, MSNBC, Fox News, whatever you're watching, their job is to literally scare you because it keeps your eyeballs glued, and they keep your eyeballs glued. They can sell advertisement because they've got viewership and they're all that fun stuff. Don't give into that fear and make money decisions based on fear-based things that you read, that you saw, that you heard, that somebody sent you in an Instagram reel, whatever. Ignore it. Think about what's actually going on in the world. Stand back from the news. Get a sense of what's going on. You'll make better decisions. All right, conspiracy number 4. This one is a lot of fun. This one I had a lot of fun with back in the 2012 election between Barack Obama and Mitt Romney, because Barack Obama made a statement, and I think it was something to the effect of Warren Buffett's secretary pays more in taxes than Warren Buffett does. And I remember thinking about that and wondering how in the world so many people could actually grab that statement, hold on to it as if it were some kind of truth, because here's the conspiracy. Rich people don't pay taxes, and because they don't pay taxes, you can avoid taxes too. Wealthy individuals and corporations pay zero taxes by exploiting loopholes and offshore accounts, and the average person can do the same thing by setting up shell companies and trusts. It's such a great conspiracy. It sounds amazing. I have clients who send me these little, TikTok and Instagram reels all the time with people explaining these, multiple trusts, and you can set them up and you can shell them, and you can have them domiciled in the Cook Islands or in the state of North Dakota or in Delaware because you'll pay zero taxes. And they always ignore a lot of detail, like, where you live matters and how much money goes, and the fact that a lot of times when you put money into those accounts, it becomes irrevocable, and irrevocable is not good for people if they're not ultra high net worth and they need to get the money out of their estate to avoid estate tax. And there's all these little factors where the average person, none of these things actually really work for them. So here's the truth. Here's why that conspiracy that the rich don't pay taxes, here's why that is false and outdated. The wealthy absolutely take advantage of legal tax strategies, but they don't avoid tax completely. And there's a lot of strategies that are legal in the tax code. If you don't like the game, support somebody who wants to change the tax code, right? If we had a flat tax and we got rid of all the tax sections and we flattened the tax code, this might not be an issue. It would be a lot more transparent, but we have a very complex tax code, and people who understand it can use it for their advantages, and that's legal. It's the tax code. The IRS wrote it. We should be able to use it. And if you know how to use it, it's a good strategy for people. So there's all sorts of things like depreciation schedules and capital gains tax rates and charitable giving and removing wealth from your net worth to avoid estate tax and avoiding probate tax and all sorts of things like that. But all of those strategies are accessible by anybody, regular people. The one thing that we don't want to do is think that we can avoid taxes through like shady or illegal, possibly, or things that generate the potential higher risk for an IRS audit because we're trying to open some trust and then layer it with another account and then blah, blah, blah. And we do all these things. I saw one today. It was like something on Facebook, and I think it just popped up in my feed. And it was something like, I don't know what it was called. It was like an Ecclesiastes trust or something like that was being sold by some religious organization. And I do say sold because literally that's what it was. And you break this apart, and they always go like, most people don't know about these special strategies that only the rich can use. But we here at blah, blah, blah firm could give you these strategies for a super low fee. All you have to do is set it up, and then you'll be in the 0.0000001% of people who know about this thing. And it's all just a bunch of junk. So anyway, when you do things like that, you run the risk of exposure to audits and fees and penalties. And frankly, if the IRS looks at a complicated entity structure and it doesn't serve any purpose, or if it looks like you're just setting up shell accounts with no purpose, they're going to make you close them. They're going to bust the whole thing apart. They're going to call certain entities invalid or void or inactive, and your whole strategy is going to fall apart because they don't serve a purpose. So I've seen the whiteboard videos where people have like 18 trusts and they all loop around and do different things and go to LLCs, and it's just a bunch of complexity for no good reason. So here's the truth. Number one, wealthy people use tax planning strategies to reduce, not eliminate taxes. Anybody who says that wealthy people don't pay taxes in this country do not know what they're talking about and do not understand the tax code. And I said that, and you can send it to somebody, and you can disagree with me and send me an email at info@lifemoveswealth.com. I'd love to have the conversation. Truth number two, anyone can benefit from legally reducing taxes through these strategies, and they're all things like Roth conversions, business deductions, charitable donations. It could be investing in tax efficient accounts. It can be moving your investment strategy to make sure that you're only capturing long-term gains. It can be restructuring your payroll, like a lot of publicly traded company CEOs do, where you take a very, very low salary and then the company pays you the rest of your salary on either deferred income or some sort of restricted stock units or grants, stock appreciation rights, things like that, where for a period of time you have to hold the stock and then you can sell the stock and you're able to do so on long-term capital gains and it saves you taxes. There's a lot of things you can do. Those are legal strategies. And if you can use them, use them. That's perfectly fine. You too can be like the wealthy and use the tax code to your advantage. Truth number 3, avoiding taxes through shady methods or complicated shell accounts and things like that, not worth the risk, opens you up for audit flags. Just, it's stupid. And usually the other person on the other end who turns you onto it, who helps you get it set up, they get a fee for helping you get that set up, and then you never hear from them. So you're just paying somebody to give you complexity for complexity's sake, and you don't know how to use it, and chances are you're going to use it wrong. And when you use it wrong, it trips some IRS thing, and then next you know you're flagged for an audit. So just don't. And for most people, I'll say one more thing about this. For most people, asset protection trusts and things that become irrevocable, which is where the tax-free part of it is, like you pull the money out of your estate, it goes over there. You personally don't pay taxes on it, but your entity will pay taxes on that income that the investments generate. By the way, they often don't tell you that. But for most people, that doesn't help you because you want access to that money unfettered, meaning you want to be able to use the money that you've saved. And if you move it over to one of these irrevocable trusts, the terms of the trust dictate how much money and how often you can get. And you can't change it because it's irrevocable. You've made an irrevocable gift to another entity that has its own tax ID, that is required to file taxes, that will have a high tax rate on the the income that it earns. By the way, after 13,000 and some odd change, trusts income is taxed at 40%. So you want to think about these things. They're not often as good as they sound. All right, conspiracy number 5. This is also one of my favorite ones. I love this too. Here's the conspiracy. The stock market is rigged and you can't win unless you're an insider. Or as George Carlin said, it's a big club and you ain't in it. Everyday investors can't win because the market is controlled by Wall Street insiders, hedge funds, algorithmic traders, and retail investors, always at a disadvantage. We always have the last opportunity to get in, and it's always rigged. Here's why this is false. While weird little market manipulation things happen, and it can be as simple as somebody, quickly doing some sort of arbitrage trading, or sometimes, rigging happens, like traders maybe 10 years ago were rigging the LIBOR index, which doesn't exist anymore anyway, but things like that happen. Financial crimes do indeed happen. And there's always short-term volatility and weird day trading, things like that. The truth is that long-term investing remains the best way to build wealth for everyday people, for anybody who's investing. And the market consistently has grown over time. Even if you go back and pull a chart all the way to before the Great Depression and pull it forward, the market's higher, always higher. It has dips, and some dips are bigger than others, but it comes back and continues to grow. Part of that is through just natural inflation. Part of that, and a lot of it, is through asset appreciation. And so you're going to make more money the longer that you are invested, despite short-term interruptions, despite the every year pullback that we have. And again, we need to remember that every year the stock market has an average of 3 to 4 pullbacks. We lose about 14 on average % of our value every single year. And about 76% of the time, the stock market comes back and finishes positive and replaces the lost value, plus gives us some reward for staying invested and staying on track. And so patience and discipline to stay invested, even when the market's moving and even when it's in pullback mode, without dealing with all the emotion and the fear-driven trading and all that stuff, you will get rewarded. Now, here's the funny thing about people who say that the stock market is rigged and that the average person can't make money. Why is it that we think the stock market is rigged, but we don't think that about the casino? We go to Vegas, we put our money on the blackjack table or the roulette table, or God forbid, like me, you get enough courage to sit down at the Wheel of Fortune machine and you put your dollar in and then it's gone. I never think that the machine's rigged. I just think the house has better odds than I do, and I'm probably going to lose because it's gambling, right? And some people are better at it than others. It's really sort of similar to investing, right? There's a lot of people who sit down at their little trading terminal in their Robinhood accounts or their Fidelity accounts or their Vanguard accounts or whatever platform they're using. And they try to do these little day trades and they're trying to pick the next big winner and, whatever. That's gambling, guys. That's not investing. That's not investing in the stock market. That's gambling on speculative stocks trying to be a winner. And we're so proud of our wins, right? So, for example, if you were somebody who bought Tesla before the election, right now you're celebrating, clapping about how much you're winning because the stock is doing so well. If you had bought it a year ago and sold it before, you're not going to tell anybody because the stock was on a downtrend and it was a loser, and you're not really proud of your losers. We're only really proud of our winners, and people only talk about their winners. They never talk about their losers. So keep that in mind. If you have a buddy who's bragging about how great their latest investment is, ask them what their worst one was. They're probably not going to be able to tell you, or they'll make something up. So here's the truth about this. The stock market is not rigged, and the reason why is because, number one, the stock market isn't perfect, but it's still the best wealth building tool in the history of mankind. There, I said it. It is. It generates more wealth than anything else in the world, and the New York Stock Exchange is a wealth building machine. It just is. And you need to invest. And as an American consumer, you're investing in your own economy and the companies that make products and goods and services that are used by Americans and are shipped around the world and are used around the world. And it makes our economy strong. And you get a chance to participate in the growth of these publicly traded companies. Yes, there's downside risk, but there's so much upside potential that it is still the best way to generate wealth if you're doing it correctly. If you're speculating and day trading, good luck to you. You're gambling. If you're picking companies that have a researchable, reportable, value-based, growth-based investment thesis, now we're talking about something totally different. Now you're thinking of like an investor. You're putting your money to work into something that is more likely to give you a return than something that you hope will shoot the moon, right? Number two, second truth, retail investors can succeed by focusing on long-term investing, diversification, and avoiding emotional reactions to short-term market swings. Short-term market swings are going to happen. It's the nature of investing. It is what it is. It comes with the territory. But as I said, if you stay invested, even when the market's coming back and you don't pull all your money out and sit in cash and wait until you get confirmation that the market's going back up, right? You're going to miss it. By the way, you're going to miss it on both sides. You have to be right twice. Very hard to do. If you can stay invested, even in 2022, when the S&P 500 had a bad year, the NASDAQ had a really bad year, and a lot of the companies that are now returning to all-time highs or have already returned to all-time highs and have pushed them higher, right? So think about companies like Tesla and Google and NVIDIA, the one that's been the highest flyer for the past 2 years, and Meta and Google and name your company. Those things were all down 40, 50, 60 something percent. They've all come back. They've replaced the value. They've rewarded their investors and then some. And so even when those things happen, you stay invested, you focus on the long term. Everything can't go up and up and up and up and up forever. Things have to come down. It's healthy for things to correct, reset value, and then move back up. So it happens. If you can avoid the emotional reactions, you'll be rewarded for it. And number three, to issue this point a little bit more, time in the market always beats timing the market. Time in the market wins. Timing the market sets you up for a high amount of risk and potential for loss. So time in the market, stay invested. It's better than timing the market, waiting for confirmation that something's going to go your way. Chances are you're going to be wrong. All right, last conspiracy. I have 6. It's January 6th. I like the, the numbers and everything matching and whatever. So here we go. Number 6. Here's the conspiracy. This one's probably going to tick some people off. I don't care. It's my podcast. Here we go. Number 6. Your home is your best investment. Buying a home is the ultimate investment. Claiming, of course, you're going to claim that real estate is always the best thing to appreciate and appreciates faster. And if you rent, you're throwing away money. That conspiracy, my friends, is false. Here's why. Homeownership can be a very valuable part of any financial plan. Primary residence, however, is not an investment. It's an asset. And those are two totally different things. Homes come with maintenance costs, property taxes, homeowners insurance, debt payments, HOA payments, all sorts of things like that. And long-term appreciation of homes, generally speaking, long-term, if you look at long-term inflation, home appreciation just barely outpaces it over a long period of time. If you look over the past maybe, 5 or 6 years, yeah, that doesn't compute. And you're probably just going, this guy's stupid because obviously my house has appreciated way faster than inflation over the past 5 years. But do that over 20, 25, 30, 40 years, I'm right. The average appreciation of house barely outpaces inflation, which is why it's not an investment. It's an asset. And renting, in a lot of cases, can be a smart financial move depending on your situation. And so there are people who move to a new area. They don't know exactly where they're going to be. Might not make sense to buy, especially if rates are high and home prices look a little high, or you can't find exactly the house that you want. Maybe you just rent for a little while. It gives you possibly some lower cost because you don't automatically have the higher housing payment. You don't have the homeowner's insurance. You don't have the HOAs. You don't have the property taxes. You don't have the maintenance cost. You can rent something at a lower price, stash away some more cash, and then go back and out into the market and find the house that you want once you know exactly what you're looking for, where exactly you want it to be in your area, and then you go forward. Maybe you're renting because it's part of your financial strategy and you're not ready to look at houses. You're saving money, you're paying off debt, you're doing something else, whatever it is. Sometimes renting can be great. Maybe you're only going to be in your area for another year or a short period of time. It doesn't make sense to buy a house. And so renting actually can be good for some people. It's not throwing away money. It's just using it for different purposes. The other thing that's important here is that people say, well, if your home's not an investment, and if I bought it at $300,000 and then I sell it for $900,000, I just made $600,000. And so how's that not an investment? Okay, first, you didn't make $600,000 because what you forget is that you had to replace things along the way to own that house. And so maybe you had to redo the driveway. Maybe you've paid for maintenance costs, like just basic things like landscaping, or maybe you pay for pool care, or maybe you've replaced the refrigerator or the stove, or you've repainted, or you changed the blinds, or you replaced the doors and windows, or you changed the carpet, or you put in new flooring, or you had to replace the roof, or you put in solar, or your heater went out. Any of these number of things that happen, you had to have a plumber come and replace piping. That should be subtracted from the $900,000 that you quote unquote made, because those are costs that went into maintaining that asset. See, we don't look at our cars unless it's some sort of a rare or maybe like I don't know, an antique or something like that, we don't look at cars as investments. We look at them as assets. Your truck, your car, your SUV, your van, whatever, it goes on your personal net worth, your balance sheet as an asset. It gets offset by whatever you owe on that asset, and then you pay to maintain it. It's not an investment. So we have to think about our houses differently. They're not investments unless you're investing in real estate. And so, truth number one, real estate investing, like rental properties that you're only buying to sell, or you're only buying to rent, which generates cash flow, which is a return, or you're investing in a REIT, which is a real estate investment trust, or some kind of privately placed real estate fund, or an opportunity zone fund, or something like that. Those are investments in real estate that can build wealth, but buying a house does not guarantee high returns, and it's an asset, not an investment. Truth number two, as I said, primary residence is a lifestyle asset. It's not a traditional investment. Truth number three, renting, as I said, can make sense if you're saving money for other investments, or if you value flexibility, or if you're just not sure where you want to be in a year or 2 years, maybe it makes sense. Or if you're just waiting for borrowing costs to come down, maybe that's the case too. I don't know. So those are the conspiracies. Did we have fun? I don't know. Did any of these make you mad? If they did, send your hate mail to info@lifemoveswealth.com. I'd love to talk to you about them. If you agree with them, send your love mail to info@lifemoveswealth.com. And I'd love to read that too. So that's all I have for you today. I hope you enjoyed it. New Year is off. Go back and listen to episode 68. Get your 5 tips for getting your financial planning off to a great start, and then the extra 5 that are next level up financial planning, financial moves that you can make, and we're going to have a great year. So if you have questions about anything I talked about today, cash, debt, investing, stock market, real estate, taxes, any of that, please reach out. Send an info or email to info@lifemoveswealth.com, or you can head over to lifemoveswealth.com and click the little button on the bottom right that says schedule time with me. And I'd love to connect and help you start your 2025 off great. And we'll do great work together, and you'll be in a better financial position in a year from now because of it. So that's all. Thanks for listening. If you enjoyed the episode, always share it, subscribe, send it to people, all that fun stuff. And we'll see you on the next episode. And until then, go be financially awesome. Take care of yourself. See ya. Thanks for listening to this episode. Be sure to like, subscribe, and share. To learn more about your financial purpose, visit lifemoveswealth.com.